You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Today on The Real Wealth Show, I'll be interviewing the anti-financial advisor. I'm Kathy Fettke, and welcome to The Real Wealth Show. Chris Miles is a cash flow expert, teaching people how to get their money working for them. He's an author, podcast host, and has been featured in U.S. News, CNN, and EO Fire. He's here with us today on The Real Wealth Show. So Chris, welcome. It's great to have you here.
Hey, it's such a pleasure to be here.
Well, as you know, we love to inspire our audience by bringing different experts on. So I'd love to start with how you got started in real estate.
By not doing real estate.
Okay.
So I started out as like that traditional mainstream financial advisor back in 2002, like right after 9/11, right? And I started doing that for a while, and I used to tell people real estate stinks. I'd say like, oh, well, look at the chart. You ever seen the chart that financial advisors pull out? They showed like a little graph going up since like 2000 BC and how awesome stocks are. And then you have like inflation down here, and then real estate's right there with inflation. You see that kind of stuff, right? Well, I would tell people, oh yeah, real estate doesn't even barely keep with inflation. You should invest in the stock market. Well, end of 2005, I call up a guy who I trained to be a financial advisor, and he left to be a real estate investor, right? And I thought, okay, he's going to go broke like everybody else I know. Let's see what happens. And so I talked to him, and I'm like, well, how are things going? He's like, it's amazing. With my dad and I, we've already doubled his income as a professor at the local university. I said, you've only been doing this 4 months. There's no way in 4 months. That's too good to be true, right?
Yeah.
He's like, no, I'm serious. It works. And so we got this debate. What's better, stocks or real estate, right? And finally he stopped me. He said, Chris, how many of your clients are actually financially free where they don't worry about money? And I said, well, a lot of them watch CNN, so none of them, right? And if you watch CNN, you're going to be desperate. You're going to be in scarcity, right? Well, and then he said, all right, well, how many of you guys as financial advisors are financially free, not off the commissions of selling the stuff that hasn't worked, but actually doing the investments you've been recommending other people do too? Because you've known people doing this since the late 70s. They should be retired by now. And I'm like, none of them were retired. He said, well, there's your problem. Yeah. And so he kind of got me looking more that direction. And when I started to realize it wasn't about accumulating money and compounding interest, it was about acceleration and cash flow. Then all the light bulbs went off, and I was like, oh my goodness. And so 2006 was when I started to I actually quit being a financial advisor, vowed never to teach about money again, went the real estate route more. And between that and some other streams of income I was able to retire when I was 28 years old in 2006.
Oh my goodness. Well, that's quite a success story.
Yeah. Now I did it twice. That's not a good thing, because that means I got back in the rat race in the recession. But that's another story.
Oh, I'm sure it's a good one. Well, let's go back to just the financial advisors versus real estate and, why they are not big proponents of it. I'm guessing it's because they don't make money on it.
Exactly. Yeah. And you're always taught, like when you look at financial advisors, they're not experts, right? They're not smarter than anybody else. They're just trained to sell products. I was really just a product peddler in a suit. Right. That was it. Like you really aren't taught about money and creating wealth. Like you're taught about saving, but you're not about it's not about creating wealth. It's not about creating cash flow and income. That's the key difference.
Well, it might be preserving wealth, maybe not, but it's a slow process. I mean, so many people have come to real wealth because when they really sat down with their financial planner and said, how long is it going to take me at this rate to get to where I want to be? It's like, 135. Like, okay, I can retire then. Great.
Yeah. It's depressing.
That's not a plan. I know when I first, when I first started interviewing experts on the Real Wealth Show, I had people coming on at the age of 30, retired because they didn't go to college, and they started at 18, and they had 12 years under their belt of doing really creative real estate deals that the difference being you can make lump sums, but you can also leverage, and you can't really do that in the other markets. All right. So let's go back to how you retired at 26 and then retired again. What happened there?
Yeah. So yeah, 2006, I was able to retire, right? And I didn't have a whole ton of money, but again, it was just about that leverage. Well, then I was kind of asking myself, what do I want to do with my life, right? And people, of course, I'm sure you've dealt with this too. It's like once people realize that you've done something cool, they want to know how you did it too, right? And so everybody's asking me, well, how did you do it? Well, I went and asked, I said, all right, well, here's how I did it. I started meeting with people one-on-one. Next thing you know, I started having like a consulting business, right? So in 2007, I came out of retirement to help people do that. And I even partnered up with some guys that were also kind of like the black sheep. We were like the ones that been there, done that. Well, the funny thing is most people we were working with were real estate investors, but they weren't the good ones. They were the gamblers, right?
Yeah.
Plus I had my stuff and I cut off my income streams because they're saying, hey, is this partnership? We should focus on this. Get rid of your other multiple streams of income. Dumb idea, right? So it was like the perfect storm. I cut off streams of income that were passive. Then we focused on real estate investors who went broke by 2007 because they couldn't get access to money by that point. Summer 2007, everything dried up. And then the next thing I know, because I'd ran up expenses in the business and at home, I'm now in the hole like $16,000 a month. So I was what felt like what should have been free.
Wow.
Now I'm on the whole $60,000 a month, right? And so I had to dig my way back out of that. And that's where I had to, no money, no credit, didn't file for bankruptcy, but I had to slowly dig my way back out to where I was finally able to retire again, more safely and much wiser the second time around, about the end of 2016.
Well, I'm not going to feel that sorry for you. You'd be so bored being retired at 26. What are you going to do with yourself?
Uh-huh. Well, I'll tell you though, like I learned so many good lessons from the recession because I was banking. I started thinking I had the Midas touch, like everything I touched, you turned to gold, when it was really a lot market driven, right? So I wasn't banking on cash flow. I was banking on appreciation pretty soon. I was starting to try to gamble with it. And that was dumb. Like when I came out of the recession, I was so burned on real estate. I hated it. I hated the fact that I had to like evict people, and I hated the fact I had to deal with all that crap. And then, soon after the recession, I started thinking, okay, maybe it's just me, right? Maybe it's just, I did it wrong. Could I be doing it right? And that's when I got turned on to like turnkey real estate investing, which I realized was like the magic bullet for me, right? I'm not saying it is for everybody, but for me, that was the thing that switched it. It was like, wait, I don't have to manage it. I can still make great returns. And yeah, it doesn't look sexy as like making $100,000 on a deal, but I don't care. $300 a month after that recession, $300 a month consistent or more, that to me was sexy, and that was the big change for me.
Yeah, absolutely. The $300 a month per property, if you have 10 or 20 or 30, it adds up. And it may be boring going into it, but over time, it's not boring at all. You've got someone else paying off your mortgage for you. You see generally values going up. I mean, we paid close to retail on a lot of our turnkey properties in 2004. Well, let's see, even in 2015, and they've since doubled in value. So you don't always have to get that 20% under market deal. It's almost impossible to do now anyway.
Yeah.
By the time you buy it at a discount and fix it up, it's probably close to retail anyway.
But if the numbers work, they work. That's the thing right now with the dirt cheap interest rates, I have people keep calling me up saying, do you think buying real estate's good right now? I'm like, yes. Even if it's smaller inventory right now, the thing is that the numbers are awesome. Like if you can make at least a 12% cash on cash return, not including, like you said, the tax advantages, appreciation, paying down your mortgage, all those other returns when you add to it is incredible. I actually mapped that out for somebody today because they were 30 years old, going down the traditional path, loading up their 401k, right? Well, I ran the numbers for them. I said, if you keep doing that, and they were saving like almost $4,000 a month. They're saving almost half their income into 401k's and savings, right? And I was like, okay, based on that rate, even if you could get it all into the 401k with your match, you would maybe in 6 years build that up to about, $400,000. And if you happen to be able to not have the 10% penalty, which you will, but if you could pull that money out, you still have to pay taxes on that money. So you lose a quarter of it right there. That leaves you $300,000. Well, as a good financial advisor would say now, right? And there's not really good financial advisors out there, right? That's why I call myself an anti-financial advisor, because it just doesn't work. But if you can only want your money to last, you're only supposed to pull out 2% a year from a mutual fund type of thing, especially with these low rates. So if you have 300,000, you pull out 2% a year, that's $6,000 a year. But I showed them the same thing. I said, taking the cash, not even getting your money out of the 401k, leaving it there, but not adding more to it, and just taking your savings and building that up. I was like, in 6 years, I mapped it out. They bought 2 turnkeys today with their HELOC, right? Then they bought a turnkey per year till they got to 2 turnkeys a year. By year 6, after they repositioned, I was like, you're now at $3,800 a month with this money. $3,800 a month. That's over 40 grand a year versus 6,000 a year. Hopefully, if the market smiles on you the right way in a 401k, it's just drastically different.
It's funny, most people don't spend a lot of time trying to figure out their retirement plans, unfortunately, and don't know how to do that. So they go to someone who specializes in that, and they assume that person has their best interest at heart. But what I think we find as we get older is that usually people have their own interest at heart. And if someone's selling you on something, they're maybe looking at where they're getting the best commission and, what's going to work out for them as a financial planner or anything. I mean, real estate agents can do the same.
Right.
So we really have to be paying attention, breaking down the numbers. And one thing that I never really quite understood is why I would want to put money into, an IRA or a 401k. Now, if the 401k is matched, I get it. But if it's not, why would I want to do that? Still get taxed on it later, but when there's more of it, so you get taxed higher, you're being told it's going to be lower, but no, there's hopefully more money in it because you've invested it. You're going to pay more for it at that time. And whereas you could do something similar when you buy real estate, you can take the money back out through a refinance and pay no tax on it. And then when you die, your kids inherit it and it steps up to market value and they don't pay the tax. So again, taxes can change, and you certainly don't want to base your investments on tax benefits, but over the past decades, it hasn't changed dramatically. It's been a pretty good deal for real estate investors for a good long time.
Totally agree. It's good short term, but it's even good long term, like you mentioned, right? I mean, that's the thing is that, if people look at the real return of the market, the S&P 500 has only averaged 7.5% for the last 30 years as a real return. But by the time even if you get the S&P 500 fund, by the time you pay your fees, you're lucky to get 6.5% in your mutual funds, right? And even what you said, like even with the 401k match, long-term, that match actually does less for you because all it does is just, even if you got dollar for dollar match, it only doubles your numbers in the end. So the longer you have it, the worse the return is. So it's only like an extra 3% a year you get. That means you maybe make 9% a year, but you got to live on less. And when I ran those numbers as a financial advisor, I was like, this is depressing. Like people won't be able to retire. In fact, if you want a 20-year retirement goal with a 60,000 a year lifestyle, which sucks, right? If you wanted to do that, you got to start saving right now about $8,300 a month now to live on 60,000 a year. That's 100 grand a year to save for 20 years to live on 60,000 a year based on average market returns. That's not even means that's what you're going to get, right? So when you factor that in compared to what you can do with real estate, which is more certain, it doesn't have, you don't have to worry about Trump tweeting something and your real estate value drops 2 or 3% like it does in the stock market, you don't have that crap. Like it's like, you don't have like a bad market day. It might be a bad market year. And even that in real estate, it's so rare. The last 6 recessions, only once did we lose value. And that was the last one, so.
It's such a slow moving vehicle. You usually have time to figure it out. I mean, even in the Great Recession, in 2007, people who were paying attention knew that those loans were going to adjust at that time. There was no secret about that. People knew when they would adjust. And if you put 2 and 2 together, it's like, oh, these people didn't even try to qualify and they can't afford it. When it adjusts, they can't pay. Yeah. It didn't take a lot to figure that one out. So yeah, you're right. And once you did figure it out, you could get out fairly quickly. It's amazing. You just don't want to wait too long.
No.
So wonderful. Okay. So where are you invested now? And let's start there. Where are you invested now?
Yeah. My number one go-to, besides my own business, of course, like, cause I can create residuals there, is my real estate properties, right? Like I love buying turnkey. I'm not the kind of person who want to do a lot of work. So I just love passive, right? As much as I can get. So I love turnkey. That's why I've referred a lot of people to you guys without you guys even knowing it,
Oh, thank you.
Yeah, absolutely. But I mean, that's what I love. I love Turnkey. I think it's the safest place plus the biggest returns you can get, right? But I'll diversify in other places too. Like I've got money in syndications in like apartment deals. I've got money in like, I even played with Bitcoin a little bit and then pulled out while I could take my money out and just like no more with that.
Fun if you were on the up.
Yeah, exactly. I only took the upside. I just took my money out. I was like, that was fun, but that's a gamble. Like that's not real investing, you know? I've done things with like even looking at franchise opportunities and investing in franchises and things like that. So, but for me, hands down, it's majority is into real estate of some way, shape or form.
Yeah.
Or notes.
And
I've
are
done
you,
notes too.
yeah. So which markets?
Markets, I've been eyeing a lot, Missouri. I've noticed kind of like this almost pilgrimage towards the Midwest, especially around Missouri. So lately my wife and I are like Missouri target, you know?
Well,
But I
and
mean,
when you say pilgrimage, there actually is one. I know
oh yeah,
for Mormons, there's a lot of Mormons moving to the Kansas City area because they have, I think that's where I don't know the details of the religion, but there is a reason why Kansas City is a highlight.
That's it. Like, you know, end of days, you know,
Yes.
make good rent, you know? So,
Yeah, that's right.
yeah.
Something like
So
that.
yeah, I got properties there. Memphis has been great for me. North Carolina, you know, places like that, mostly Southeast to Midwest.
Okay. Wonderful. And then when you said that you were giving up passive streams of income when you before I guess it was a decade ago, what did you let go of and why?
Yeah. So, you know, it's interesting because like I started to buy real estate and create some passive income there. Cause I always tell people there's two types of passive like income, right? There's passive, which I call investment income, right? Where money makes money. And then there's the residual, which comes from business. And so I vowed, like in March of 06, I vowed never to teach about money again. I quit being a financial advisor. I was just being a mortgage broker. And while I was doing that, one of those real estate friends kind of gave me this cool business idea. He said, Chris, do you like doing mortgages? And I said, you know, I love teaching people and helping them get creative so they can cash out, refinance, and invest, right? But I absolutely hate paperwork. He said, well, why don't you find somebody who does do that and then just split the deal?
That was the worst part.
Yeah. Yeah. I was like, I hate paperwork. So he's like, well, find somebody who's a nerd that likes doing that, split the deal. So we split it 50-50 on the origination. So I would only spend like a half an hour to an hour with the client, pass it on to him because he didn't have to sell or do anything. They just had to figure out what to do next.
Yeah.
They didn't call me for all the follow-up questions. So after half an hour to an hour, I get a check for like $1,000 or $1,500 in the mail. And I was like, well, that was easy. Where else could I do that? And so there's people I realized I kept sending connections to. I'm like, well, hey, let's create a deal. Do you have a referral fee or something like that? And even a wholesale jeweler would pay me 5% kickback if somebody went there and paid like a third of the cost they paid in the mall, right? So there would be like this win-win-win transaction. It's like a win for the business owner, win for the customer, and then win for me as being that kind of like that broker, right? So I started doing what people now call like affiliate. But for me, it was just connecting. You know, that's all I was calling it back then, right? And the next thing I know, like between that and the other stuff I was doing, I was making $4,000 or $5,000 a month, working only a few hours a week. And I'm like, well, dang, I only need 35 at that time. I only needed $3,500 a month to live. You know, now I've got, with a blended family, we got 8 kids. So,
oh my gosh, 8 kids. You're going to need a little more money than that, huh?
Exactly. So now we're like 15 to 20 grand passive is what we need to have now. But, you know, but still that's, I mean, that's why it took another 10 years after the recession to hit that. Right. But that's the thing is like, it was a mind blowing aspect of, oh, I don't have to do everything, right? I can connect people. So when I went to start that company with those guys, they said, hey, you're doing all this kind of stuff on the side. Get rid of that. Just focus all on the mission. Just do what we're going to do. We're trying to educate the planet, right? You know, so just focus on that. Basically be a coach, you know? And that was probably the worst thing I could have done, you know, because if I would have kept doing that stuff, then even when our marketplace was going broke and we had to find a whole brand new market to market to, right? We would have been much better off. But I mean, most of those guys, almost everybody that worked with us quit. I was one of the few people that was left standing in that business before things turned around and boomed again, you know?
Wow. Fascinating.
Yeah.
All right. So how would you say that real estate has changed your life besides what you've just kind of shared in addition to what you've shared?
I'd say the best way it's changed my life is just blowing my mind, like seeing what's possible, right? Just like what happened when my friend talked to me and kind of talked me out of the financial advisor role, because remember, I was thinking, how do you save up so much money and then live off less than the interest? That was like, I was thinking like my goal was to save $2 million and then live on 60,000 a year, right? That was my dream. If I could do that by the time I was 40, that would be awesome. And now 60,000 a year is crap. Like it's nothing, but back then it seemed like the dream. And with real estate, all of a sudden it was like, wait a minute, even though it does take that time to ramp up a little bit, there's that kind of that compound, I call it like that income avalanche. It's like a compound income effect. It takes a launch, but once you get going, it just escalates. And it was so much better. Like to know I had a real asset. I wasn't banking on some crazy market that's bipolar that goes up or down, whether it makes sense or not, right? Where I feel out of control. To be in a place where I felt like I was in control of my life and my money, that's what I wanted in the first place anyways. So for me, real estate was like that easy gateway to get there.
Yeah. So if you were to give advice to somebody starting out today who's thinking, oh man, we don't know what 2021 will bring. We hope it's not more of 2020. We hope this is not the beginning of a decade, but or a new normal. But it's such uncertain times. I mean, what would you tell people who are thinking, did I miss it? Is it too late? Are there going to be a bunch of foreclosures? Should I, are we going to no longer be the United States of America? I mean, who knows? It's crazy times. What would you tell somebody just starting out in real estate?
I would say not at all. I mean, like the one problem, I had this discussion with somebody just the other day, is they're thinking like, well, should I wait till 2022 when things come crashing? I'm like, you know what? There's gonna be great opportunity there, and maybe keep a segment of your money for that. But right now, you can't beat right now. If I remember back in March and April, I was scared, wondering if people were going to pay my rents.
Yeah.
But I'm so glad I was in, because things just kept going. Like the value of the properties kept going up. Now we got properties I've only had for 3 years. I'm thinking, maybe I should reposition and sell and get out of, right? So I think the great thing is that the time is now. You can still do things now and later, right? Is that you don't have to just go all in and swing for the fences. But there's great reason right now to be in real estate. And if there's anything we can trust, even if we go into a recession, great. Don't buy $500,000 properties, buy the stuff that I know you've got, buy the things that are maybe around 100,000 or so, the lower price properties, because that's what people are going to rush into. Yeah. That's either going to drive your rent prices up like it did the last recession, or it's going to drive the value of your home up, or both, so if you're going to buy, buy something simple. Don't do it on your own. Don't buy in the western half of the US where we live, because that sucks. Look out east for the most of us, right? Is like, look out there. And by the way, I guarantee if you're in California, which a lot of my followers are, just don't have any real estate. Whatever real estate you have in California, sell it. Get rid of it. I don't have to look at the numbers. I already know you probably have equity and no cash flow with it. So look out east, there's great opportunities out there, and you already know this. You've got those deals right there. You got the inventory.
Absolutely. Good stuff. All right. Yeah. I just got to hear John Burns speak again, and Rick Sharga at the event that I was just at. My first time on an airplane in 9 months, but I went and I survived as far as I can tell. I'm still here. But they were saying the same thing. Don't be expecting a bunch of foreclosures, because in this time around, the Federal Reserve is throwing everything at it to keep people in their homes, and banks do not want to see a bunch of foreclosures, and they're going to create all kinds of loan modifications and these forbearances. They're going to let you keep extending it. So if you're waiting for that, it's probably not going to happen.
They're trying to drive up inflation right now too. I mean, they're wanting inflation, which
they're trying to create it.
Investor. Yeah, that's perfect for us.
They're literally, when you have the Federal Reserve, the largest money-making machine in the world, saying, we want prices to go up. We're going to give everything at it to make that happen. That's a sign, for sure. And on top of that, that means inflation on materials costs and labor costs. And there's about a lack of 300,000 or 400,000 homes every year that's needed and not being built. And the builders are unable to build anything, like you said, in that $100,000, $200,000 range. Yeah. So I just think that's the place to be. And we're going to see both cash flow and appreciation over the next few years. That's my prediction.
Well, I was talking to a guy like in a real estate group that we're part of, and I was saying, hey, you build, like, what are the lumber prices looking like? He's like, oh, they've more than doubled. Even though I buy from Canada to get cheaper, it's more than doubled. I'm like, but the prices haven't gone up for the new construction. He's like, I know. Where's the profit?
They're starting to. They're starting to.
They're going to start drive. They have to, because they won't have profit. They don't. They'll sink. So guaranteed, you're going to start seeing values go up even more.
There's a small window right now to buy those new homes before prices go up. I know unfortunately, this has been the case for Rich and me. We've been so busy with all of our webinars that I forget to invest. So we're like, we got to just stop and apply for some loans and get some of these properties. Anyway, it's really been a pleasure having you. Thank you so much for sharing your wisdom. Really appreciate it. Have a wonderful rest of 2020.
You too, Kathy. Thanks.
And thank you for joining me here on The Real Wealth Show. If you're interested in acquiring turnkey properties and maybe especially interested in owning brand new homes that cost less than $200,000 that cash flow and are located in the fastest growing parts of the country with experienced property management in place, it doesn't get more turnkey than that. We're hosting our live event this Saturday virtually. We'll have a panel of investors who have bought turnkey and new rental homes. So we'll find out how those properties are performing. And we'll also have builders and property managers showing us what's available in their markets. So again, you can sign up for free at realwealthshow.com. I'm Kathy Fetke, and thanks so much for joining me here on The Real Wealth Show.